Lucid Group Inc. closed its most recent regular trading session on Tuesday, June 2, 2026, at exactly $6.65 per share, ticking up slightly by about 0.61%, with an intraday trading range fluctuating between $6.51 and $6.81. To understand where the company stands right now, you have to look beyond the daily price action and confront a massive, silent shift taking place in corporate governance and production infrastructure. While the headlines focus on the volatility of electric vehicle manufacturing, a newly filed securities fraud class action lawsuit has quietly altered the structural risk profile of this entity. A coalition of major investor rights firms recently announced a legal filing covering the period between February 25th and April 13th of this year, directly alleging that senior executives failed to disclose severe supplier quality issues that crippled the delivery ramp of their flagship SUV, the Lucid Gravity. This hidden production bottleneck completely shattered initial expectations, resulting in a dramatic revenue miss for the first quarter of 2026, where the company posted roughly $282.46 million against consensus Wall Street estimates that sat north of $433 million. This discrepancy between executive narrative and operational reality reveals that the actual floor of the manufacturing process is much more fragile than the public markets were led to believe, complicating the calculations for any modern individual brokerage account. The prevailing market narrative suggests that as long as the Public Investment Fund of Saudi Arabia continues to pump capital into this enterprise, the equity remains an asymmetric bet on premium automotive engineering. Retail sentiment across various online investing platforms often assumes that sovereign backing acts as an absolute safety net, guaranteeing an infinite runway until production scaling solves the unit economics. The expectation is that building cars with industry-leading range will inevitably yield profitability. However, the cold reality is that a massive sovereign fund cannot build local supply chains or fix engineering defects by sheer force of capital allocation. Despite receiving an influx of $1.5 billion through convertibles and unsecured loans late last year from IR Third Investment Company, the underlying business burned through hundreds of millions in cash during the first quarter alone, posting an operating loss of approximately $951.55 million. The operational math is stark because the cost of goods sold reached $594.17 million against that $282.46 million top-line revenue figure. This means that every single vehicle leaving the factory line currently costs twice as much to manufacture as its final retail price, a structural deficit that severely tests the thesis of retail participants using advanced self-investing apps. When you examine the raw trading volume and institutional positioning over the past 30 days, the tension between major asset managers and short-term retail momentum becomes obvious. Average daily trading volume has consistently hovered around 19.12 million shares, reflecting a highly liquid but heavily contested battleground. Large index fund managers like the Vanguard Group, BlackRock, and State Street Corporation maintain their passive blocks due to index tracking requirements, but active institutional desks have pulled back, forcing retail traders on platforms like the Robinhood app to absorb the daily volatility. The stock is currently sitting deep in its 52-week trading range of $5.55 to $33.70, showing just how brutal the valuation compression has been since the mid-decade peak. This trading velocity indicates that short-term speculators are actively playing the intraday swings, treating the equity as a high-beta vehicle rather than a core position for long-term wealth accumulation. The presence of elevated options flow indicates that professional trading desks are pricing in substantial execution risk ahead of the upcoming summer production updates, utilizing sophisticated structures to hedge against further supply chain disclosures. To truly grasp the scale of the financial pressure, we have to look closely at the balance sheet adjustments that occurred directly after the April disclosure. When the true extent of the first quarter production slowdown leaked alongside the revenue miss, management immediately announced a massive $1.05 billion capital raise, which included a highly dilutive $300 million public stock offering. For retail investors holding equity inside an individual brokerage or executing trades through the Interactive Brokers platform, this capital structure adjustment was a sharp reminder of the cost of expansion. Dilution is the ultimate enemy of long-term equity growth, and when a firm is forced to issue shares near its 52-week lows just to maintain working capital, it signals that the operational runway is shorter than anticipated. This dilutive cycle is exactly why retail capital is growing increasingly cautious, shifting focus away from raw engineering specifications towards basic cash flow sustainability. Comment below how many shares of Lucid Group Inc. you currently hold in your portfolio right now, or if you are entirely avoiding the electric vehicle sector given these persistent manufacturing headwinds. Hearing where the community stands helps map out whether retail sentiment is capitulating or doubling down on these depressed asset prices. Looking at how this corporate entity operates, its business model fundamentally relies on a vertical integration strategy that mirrors early luxury car builders, but carries an immensely higher capital requirement.
The company designs, develops, and manufactures premium electric powertrains and battery packs entirely in-house at its manufacturing complex in Casa Grande, Arizona. By maintaining strict control over the battery chemistry and motor architecture, they managed to achieve an EPA-certified range exceeding 500 miles on their luxury sedan models, setting a technical benchmark that outpaced the core fleet of major competitors like Tesla stock or legacy luxury alternatives. In addition to direct consumer vehicle sales, the enterprise attempts to monetize its proprietary intellectual property by supplying powertrain components to external automotive brands, including a high-profile technology sharing agreement with Aston Martin. This secondary business segment is designed to create a high-margin recurring revenue stream, acting as an industrial buffer against the highly cyclical nature of consumer auto sales. However, the overhead costs of maintaining a global sales infrastructure and specialized retail studios have continued to outpace these technological joint ventures, keeping the corporate operating margin deeply negative. The historical trajectory of this organization outlines why the current valuation friction is so painful for early backers who tracked its public market debut. Founded back in 2007 under the name Atieva by a group of clean energy innovators, the firm spent its first decade focused strictly on manufacturing advanced battery packs for international racing series and commercial buses. It was not until a complete rebranding in 2016 that the corporate focus pivoted towards producing an ultra-premium consumer vehicle. The initial public entry occurred through a merger with a prominent special-purpose acquisition company, Churchill Capital Corp. 4, which valued the combined entity at an astonishing $11.75 billion prior to production scaling. The early days were marked by immense optimism, especially when their debut sedan won prestigious automotive design awards and shattered public perceptions of electric vehicle range limitations. Yet the transition from engineering a functional prototype to managing a multi-tiered global supply network proved to be an incredibly steep hurdle, leading to serial production delays, executive turnarounds, and multiple structural reorganizations that severely diluted early stakeholders who placed their capital through traditional investing sites. Understanding the broader market environment requires checking how this specific company stacks up against alternative options across the modern investment landscape. An individual seeking portfolio growth today faces a dizzying array of choices, ranging from direct individual brokerage accounts to automated asset allocation tools like Schwab Intelligent Portfolios. When wealth managers design long-term strategies, they typically rely on stable, cash-generative vehicles such as Fidelity Investments, Core Fidelity ETFs, or diversified Fidelity mutual funds to establish a defensive foundation. For growth-oriented sectors, capital often flows into highly profitable mega-cap technology firms, making Apple stock or Nvidia stock standard inclusions within a standard Fidelity brokerage or managed Fidelity wealth management program. In contrast, an unprofitable, highly capital-intensive manufacturing business like this electric vehicle builder represents a speculative outlier that rarely fits into conservative vehicles like Fidelity IRAs. The stark contrast between a high-profitable semiconductor giant and a struggling premium automotive fabricator explains why institutional capital has steadily rotated out of early-stage clean technology and into automated infrastructure, leaving small-scale retail participants to navigate the high-risk auto sector independently. This brings us to the core tension driving the future outlook of the company, where the conflict between executive projection and physical reality will ultimately decide its corporate survival. Moving through the remainder of 2026, there are two distinct operational paths that could unfold for this entity. In the optimistic scenario, the newly appointed leadership team successfully resolves the component quality defects with their primary suppliers, allowing the Arizona assembly lines to achieve an uninhibited manufacturing cadence for the luxury SUV. If the firm can smoothly ramp up vehicle deliveries throughout the third and fourth quarters, the pent-up demand within the premium utility vehicle market could generate a rapid acceleration in top-line revenue, surprising the institutional desks that have heavily shorted the equity. This operational recovery would drastically reduce the quarterly cash burn, extending the company's financial runway and potentially allowing it to transition towards a self-sustaining capital model without requiring further highly dilutive equity raises or emergency sovereign credit extensions. Conversely, the pessimistic scenario involves a prolonged struggle with supply chain logistics, where localized component shortages continue to choke off assembly line velocity. If the manufacturing defects prove to be systemic rather than temporary, the organization will likely miss its revised full-year delivery guidance, further alienating retail traders who utilize the Fidelity mobile app or the Robinhood stock trading platform. A sustained failure to scale production would leave the firm completely dependent on continuous capital injections from the Saudi Public Investment Fund. If the sovereign wealth fund decides to impose stricter financial covenants or demands greater equity control in exchange for further funding, the remaining public shares could experience extreme downward pressure, trapped in a structure where retail equity is consistently diluted to cover fixed factory overhead. This risk is compounded by broader macroeconomic pressures, as sustained high interest rates continue to dampen consumer demand for vehicles priced well above the luxury threshold, squeezing margins across the entire premium transport sector. When individual market participants evaluate their choices across modern digital applications, whether using the SoFi trading platform, managing assets through SoFi Active Investing, or exploring automated solutions via a SoFi robo-advisor, the primary metric must always be execution consistency. Speculative companies can capture public imagination with elegant industrial designs and bold technological claims, but long-term market valuation is ultimately a function of sustainable unit economics. The current legal battles and production halts surrounding the new utility model demonstrate that the gap between a compelling design philosophy and an efficient mass production system is incredibly vast. For retail traders managing an active portfolio through specialized systems like Interactive Brokers Trading or an Interactive Brokers account, navigating this specific equity requires a deep understanding of corporate cash burn rates and the precise mechanics of public equity dilutive offerings. To conclude this complete assessment, the overarching reality of this luxury electric vehicle manufacturer is defined by a deep structural contrast between engineering capability and financial execution. The market initial expectation was that premium battery technology and endless sovereign funding would naturally pave a smooth path towards global market capture. The reality, as exposed by the recent securities litigation and severe revenue contraction, is that supply chain vulnerabilities and massive fixed costs are actively eroding the company's capital base. While the underlying engineering remains undeniably impressive, the business itself faces a critical operational bottleneck that cannot be solved by marketing campaigns or public relations strategies. Investors utilizing any modern online investment network must carefully weigh these documented execution risks against the potential for an industrial turnaround. The expectation of easy scaling has officially collided with the reality of complex manufacturing, and only those who track these structural metrics will successfully navigate the volatile terrain ahead. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this